Hello and welcome to Money Matters TV. I'm Patricia Dunn from the Dunn Group at Merrill Lynch, and I'll be your host this evening. Joining me as my co-host is Jim McGrory of Drucker and Scaccetti. Thanks and welcome to the show.
Thank you, Pat. Pat, I'm curious, what do the market prognosticators say is driving the market up right now?
Very good question. And as you know, this program is taped. So yes, the market is up now, but wait 10 minutes, it could be down again. But the market did bottom out February 11th, 2016, and between February 12th and February 29th, the market rose a big 8%, and then we came into March roaring like a bull. First day of March, we were up over 350 points. So the market prognosticators are saying that it's a couple of different things. First of all, the gross national product numbers were revised upward for the fourth quarter of 2015. So that was good news.
Right.
Secondly, we're starting now finally to see some price stability when it comes to oil and actually some hints of cuts in production.
Oh, okay.
And that's helping the market. And then the cyclical stocks are doing well, which indicates that the global economy is picking up. So let's cross our fingers that nothing sends us the roller coaster back down again, but for the moment we're up. But given this timing, people are very concerned about their taxes.
Absolutely.
And really for the last 6 months, we have been in a down market.
Sure have.
So Jim, would you share with us some thoughts as to what people might want to do in a down market to help their tax situation?
Absolutely, Pat. Thank you. Yes, Pat, in a down market, when values are depressed in a person's portfolio, it is an opportune time to do tax loss harvesting. What that would mean is that they meet with their financial advisor and go through their portfolio, and if there are certain securities that should be liquidated and get out of that security to sell and get the loss, the capital loss. The benefit of capital losses is if you have an overall capital loss position, you'll be in a capital loss carry forward. Capital loss carry forwards are carried forward indefinitely. Also, you could use $3,000 of your capital loss against ordinary income. So you're getting a benefit tax-wise for that. Also, when you have a down market, there's ability to gift securities. So in essence, you're being able to transfer wealth to the rest of your family and not incur a significant gift tax on that because the values are lower. Now, the hope is that that stock or that bond will increase in value, but that increase will be outside of your estate because you've gifted that security away.
At a discounted value because the market was down.
Correct.
Very smart.
Correct. Now, Pat, I work with many financial advisors, brokers, wealth managers. Could you tell me what the difference is between those types of advisors?
That's a really good question that I get all the time. When I tell people that I lead a wealth management team at Merrill Lynch, the eyes glaze over.
Yeah.
So what I've taken to do to explain it is to compare it to something that everybody understands, and that is taxes.
Okay.
In the tax-paying world, as taxpayers, we have a choice of 4 levels of service. And we would never say one level was superior or inferior to the other.
Okay.
But we know that as we go up the levels, each level requires a higher level of education and a broader offering. But quite simply in the tax world, you have TurboTax for those who want to do it themselves. You have H&R Block if you want to deal with a person and have a simple tax return.
Sure.
You have a public accountant, and then you have a CPA. And the CPA has the highest level of education and the broadest offering. So if you're approaching retirement and you're thinking about, should I sell my primary residence and downsize to my vacation home at the Jersey Shore?
Right.
You wouldn't take that to TurboTax.
Yeah, I don't think so.
And you wouldn't take it to H&R Block.
Right.
You'd call up a CPA because you're selling a primary residence, but you're not buying another one. What's the tax consequence?
Right.
If your income remains the same, do I pay more as a Pennsylvania resident or a New Jersey resident? These are real questions requiring real answers. The same thing in the financial services industry. We have the same 4 levels. For the do-it-yourselfers, we have E-Trade or Vanguard or Fidelity. Then you've got your classic broker that you talked about, otherwise known as I've got a guy.
Right.
All right. And they focus on a product, just like H&R Block. They could be a stockbroker, a bond broker, an annuity broker, a mutual fund expert. Next up is your portfolio manager. They bring science to a portfolio. They turn collections into real portfolios.
Okay.
And then at the CPA level, you have wealth management. And wealth management focuses on the client. And where is the client now? What's the essential need, the important want, and the aspirational dream? Where do they want to be, and what's it going to take to get them there?
Yeah.
That's what I do in wealth management. But let's get back to taxes for a moment. Can you, I've heard about this backdoor Roth IRA contribution.
Right.
What is that?
The backdoor Roth IRA contribution is an opportunity for someone who at a high income level would have the ability to make a contribution into a Roth IRA. Now, typically, what's supposed to happen if you have a high adjusted gross income, you will not be able to make a Roth IRA contribution directly. But there's been a loophole that someone could make a traditional IRA contribution. It will be non-deductible, and then once you have basis in that non-deductible IRA, you would then convert that non-deductible IRA into a Roth IRA. So you've in effect got around the direct contribution to the Roth IRA rules. Now, what is very interesting, this has been a very highly advertised loophole, if you will. It's all over the internet. And as with all loopholes, there's always, the government wants to close them. President Obama released this week, or at the end of last week, his budget for the next year. And one of the line items in the budget is the closure of the backdoor Roth IRA option. So stay tuned. We're keeping our fingers crossed that it's not in the new budget, because I have several clients that we've recommended to take the backdoor Roth opportunity.
I never knew it to be called backdoor, but we do that all the time, and it's good to know that we may not be able to going forward. Well, when a client comes into you and he says, should I convert my traditional IRA to a Roth? How do you approach that?
It's a very good question, Pat, and it's quite honestly, a complicated and a lot of factors need to be considered. Basically, the end result, what is happening is that person is going to have to take taxable income in the year of conversion. Now, it's a tough call that someone will be taking in taxable income and they won't have the cash to pay their taxes. So we always have to sit down with somebody and run with the numbers and work with their financial advisor if it makes sense to do the IRA to Roth conversion. The best situation, or you would say the individuals that would be in the best position to do a Roth conversion would be someone who really doesn't need the IRA money in retirement. So oftentimes a wealthy individual that will be in essence passing their IRA onto the next generation. So that type of person is a good candidate. A second would be someone who has the ability to pay the taxes not from the IRA money. So it's not a yes or no, very easy question. It's something that you do have to plan for, work with your CPA, work with your wealth manager to figure out if it is a good option for you.
And isn't it also true that there's income limitations? So if someone's been laid off from a job and has a particular year where their income is way down, that it might be more attractive that year than another time when they're working full-time?
It would be. That's a great question, because when your income is down, your tax rates will be down. So if your tax rates are down, and again, in a down market, when the value of your account is down, it's a good idea to look to see whether a traditional IRA to Roth conversion would be good for you.
All right.
The benefit of a Roth, the Roth IRA is an account that it grows tax-free. Unlike a regular traditional IRA, there's no required minimum distribution when you're over age 70. So it's a tremendous vehicle if you can get into a Roth, even to start saving in one.
All right. Well, would you have a minute to answer one of our viewers' questions?
Oh, absolutely, Pat.
All right. Well, we have Nancy Jenkins, who sent us a question from the Newtown Square area. And she asks, what is the difference between qualifying dividends and regular dividends?
You know, that's a great question, because, and it's one that I can see popping up when someone is preparing their tax return, because they're going to be getting a 1099 from their broker, and the 1099 will show two amounts. The one amount will be a qualifying dividend amount, and the other will be an ordinary dividend amount. A qualifying dividend is a dividend from generally a domestic corporation or some foreign corporations. The benefit of a qualifying dividend is that it is taxed at the lower capital gains rates. So if you're in the zero tax bracket for capital gains, you'll pay zero tax on that capital gain. Again, if you're in a 15% bracket or a 20% bracket, you'll pay, again, the capital gains rates on that qualifying dividend. An ordinary dividend, on the other hand, is taxed at ordinary income rates. So almost like a money mutual fund dividend will be taxed at ordinary income, similar to your paycheck.
Similar to your paycheck.
Yep.
All right. Well, if you as viewers have more questions, here is how you would go about sending your questions into Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our hosts and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Welcome back. And now it's time for our special visitor. With us tonight is Nick Yzzi, a CPA from Harleysville, and we have a lot of questions for you.
Good. Thank you, Pat and Jim, for asking me to be here tonight.
Welcome, Nick.
It's good to be here.
Why don't we start with what has changed, if anything, when it comes to capital gains rates for filing taxes for 2015?
Not a whole lot, Pat. The rates are basically still the same as they were in 2014. So the rates start at 10%, and they go up to 39.6%. And in between, you have 10, 15, 25, 28, 33, 35, and 39.6. So you can pick which one you'd like. And that top bracket kicks in around $490,000 for a married couple. As far as capital gains are concerned, and Jim just mentioned some of those rates, if you're in the first two brackets, the 10 and 15% bracket, and you do have a capital gain, your capital gain rate is actually 0. And then when you get to those middle brackets between 15 and 35%, or 25%, 33%, I'm sorry, and then your capital gain rate would be 15%. And then for those at the upper bracket, at that 39.6%, their capital gains rate would be the maximum rate of 20%. So it ranges from 0 to 15 to 20. So, and the rates haven't changed, but just the statutory additions, the inflationary adjustments, are the only thing that's happened since 2014.
All right, but there's been a number of other changes.
Absolutely. Yep. It's been a very, very, very busy year in the
Yes.
tax world. And last week, Nick, I saw a headline in the Wall Street Journal, and it basically said older Americans are saying Social Security is giving them the wrong information. That has something to do with some Social Security tax changes last year?
There was a change around November, beginning of November, called the Bipartisan Budget Act of 2015. And you haven't heard a whole lot about it, but it's starting to gain some additional momentum here because there's some timetables coming up. And basically what it's representing is that there's a change to the Social Security laws for those who are reaching full retirement age. So for someone reaching full retirement age, they were born in 1950, so they're about 66 now. They have a time period right now. There's two elections that are changing. One is called file and suspend. So in essence, if I reach full retirement age March 1st, I can file for retirement benefits, and then I can suspend the collection of those benefits so that I can increase my retirement benefits by 8% for each year that I wait. So you file the election and then you suspend it, and then you couple that with something called a restricted application that my spouse can elect, and in essence she can start collecting on my benefits. And when you combine the whole package over a period of years over the actuarial tables, you in essence can pick up about $80,000 or $90,000 of additional Social Security benefits for the average couple. Well, those elections are going to go by the wayside, and this is a key date. If you are approaching full retirement age, you have until April 30th of this year, April 30th, 2016, to make this election. So what I would tell people is don't listen to what Social Security tells you, because it's not that they would deceive you. I really don't think they understand the rules. You really need to talk to your CPA, who needs to go through a variety of calculations to see whether this file and suspend election is best for you. There's a variety of factors. It depends on what your health might be, how long you expect to live, if you have the crystal ball to figure that out, how long you intend to work, how long your spouse intends to work, and what the combination of benefits might be between you and your spouse. It's a very complicated process. So what I would ask your listeners to do would be that if you're in this situation where your spouse is was already 62 by 12/31/15, the December we just passed, if that's a situation, or if you're at full retirement age, you have to do something before April 30th, 16, or those elections go by the wayside.
Okay.
So it's important to act on it as soon as possible.
All right. Well, this is an issue that comes up all the time. Many of our viewers are very worried about identity theft when it comes to filing their tax returns. What has been your experience as a CPA in this area, and what kind of advice can you give people?
Well, it's becoming more predominant in that, you have folks out there who are very creative in stealing Social Security numbers. In fact, the IRS website has been hacked twice. What they've done is they've hacked the PTIN website. In fact, that happened. We were at a seminar together, me and Jim, and there was a criminal investigator there talking about fraudulent tax returns that have been prepared by these folks who steal Social Security numbers. And one of the easiest ways to do that is to hack into the IRS website, steal the PTIN numbers, which are basically their professional tax preparers' identification numbers. Then they get their Social Security numbers of their clients. Now, I don't know how successful they were there because they're not saying, but there's a variety of ways that people steal Social Security numbers, and then they file a fraudulent tax return using your number. And then when you file your return, you get a notice that, particularly if it's electronic, you've already filed. So if that happens, what you need to do is you need to contact IRS. There's an affidavit you need to file, a form 14039. Contact the IRS, and there's a lot of information on their website. But it's amazing how sophisticated this has become. One situation they described was that this has become so prevalent that what they'll do is they'll change your address to a rural address. And they have these runners who actually go into rural areas and they wait for the refund checks. I guess they check every day. And they wait for these refund checks to come in. Then they steal the refund check out of the box because they know that they filed a fraudulent tax return under another address. And in fact, they arrested one person who had 50 refund checks on his possession.
Wow.
So, I after that seminar, Jim, I disconnect my internet every night. When I'm done, I disconnect it, because the best way for someone to hack in, from what I understand, is if you have live internet. So it may be best to just have a switch to shut it off. so that no one's trying, because they usually do it in the middle of the night when they know people are asleep. But
Yeah.
it was pretty scary as far as the predominance of what's going on out there, how creative people are when it comes to identity theft. So that's just one aspect on the tax side of what identity theft is producing.
Is it enough to just turn off your computer, or do you have to do more than that?
You could turn off your computer as well.
Okay.
I mean, but the computer people tell you don't turn off your computer because, so you either do one or the other.
Okay.
But also have you know, the backup systems
Right.
to enable you to protect yourself from malware and somebody trying to break in.
I was most surprised by the comment that the speaker mentioned about when you go to the doctor, and at the top of the form it has your name and a box for your Social Security number.
Yes.
And how many times do any of us fill out that Social Security box? And so many people raised their hand, including me. And he's recommending guard your Social Security number as best as you possibly can.
Yes.
And don't give it away frivolously, because the doctor's office doesn't need your Social Security number. They have your
Correct.
medical. They have your medical card. They've got all the information they need. And again, medical card information should be protected as well.
Yes.
So.
And unfortunately, even like the Medicare system, I mean, it's based on your Social Security number. So even someone in a doctor's office can steal your number. And in fact, they said they have people who go around, they get jobs, then they get a job in a CPA firm, or someone who has access to Social Security numbers, they steal a database and then they leave after 6 months. So it's very sophisticated. They know what they're doing.
Yeah. Scary. It's very
Scary
scary.
stuff.
Yeah. I think he alarmed quite a few of the CPAs that were there that day, right, Pat?
Yeah, it really did. Really
Yeah.
did. Nick, recently I got my W-2 from work, and in the envelope was this Form 1095-C,
Yes.
and it has something to do with the Affordable Care Act.
Yes.
Could you explain what that's all about, and what if someone's preparing their tax return this year, what they should be concerned with?
Yes, and there's a couple of things here that will probably create a little bit of an issue, but everyone who's covered by health insurance, as you know, the Affordable Care Act, or what we call Obamacare, requires almost all individuals, unless they qualify for an exception, to have health insurance. So if you're working for an employer and he's providing insurance, or even if you have Medicare coverage, let's say, the appropriate entity has to file a form with the IRS verifying whether you had insurance coverage for every month of that year, because you have to have insurance for every month of the year. There's some exceptions to that. And so what they'll do is they'll send you a form, and then they send the IRS the form, just like a 1099 series. And it'll tell you whether you were covered for each of those months. And then ultimately they'll check back to see what your response was to a question on your tax return now that says, were you covered by adequate insurance for 12 months of the year? And if you were not, then you have to fill in these forms. You may have a potential penalty, which could be up to $695 per person for 2015. It's escalating, or 2.5% of your household income. It could become quite expensive. So they're going to reconcile those forms, I guess, if their system can take it. We're not sure. But they're going to reconcile these 1095s that you receive as a recipient that are posted to your Social Security number, reconcile that back to the tax return, and then they'll be sending out notices to see whether you actually did have insurance, and if you did not, if their records indicate you did not, then they'll follow up with questions to see whether you're subject to the penalty. So that's their way of using the IRS to enforce the mandate that all individuals have to be covered by health insurance.
Now, elder fraud is getting to be a bigger issue, Nick. And we sometimes have clients call us and say, I got a call from the IRS and they're demanding so much money.
Yes.
And I tell them, the IRS doesn't call you and ask for money. What should people do when they find themselves in this position? Because it amounts to elder fraud.
Sure. And unfortunately, these scams are targeted mostly towards elder people, but not always. But there are a variety of scams out there. In fact, there's been 4,500 people who've paid $23 million of funds that they thought were going to the IRS, and they were so scared because these people call, they say, you owe money. They say, if you don't pay this right away with a credit card, we're going to send the police out to arrest you.
Right.
Which is a misnomer, because the IRS doesn't send police. They have their own police. It's called the Criminal Investigation Division. So you'll never get a call from the IRS demanding payment. Now, if you're involved with a collection officer from the IRS, he could call you back, but he's already initiated correspondence ahead of time through writing.
Right.
But 99% of the times, if you're getting a call from the IRS, it's a fraudulent call. And some of these people are located in foreign countries. In fact, what they're doing now is they have something called caller ID spoofing. So there's this technique that you can use that it looks like it's a call from the IRS. So when on your phone it'll say Internal Revenue Service. So
Holy
people
smokes.
see this and they say, wow, it is IRS. So don't respond to it. You call the IRS and you report the situation. In fact, you can go onto the website and they have a quick form that you can just fill in and give them the details as to what happened, just so they have a record of it. But I know at least 6 people who've been contacted already, and I've gotten calls at night, people in panic, just people I know, some clients. And it's very unfortunate that people are so scared. I mean, some people are just so scared of the IRS.
Yep.
It's just amazing. But, the best thing is just hang up.
Just hang up.
Yes.
Okay, and then go on the IRS website.
Yes.
Don't call the police. This is
Correct.
something that you do directly with the IRS.
You can go to the IRS website, and it's called the IRS Impersonation Scam Reporting.
All right.
But if you just type in IRS scam, it'll pop up.
Yeah.
Okay. One last question before we wrap up. Businesses forever have to do with repair regs. What's happening in that arena at this time?
Well, there have been final regulations as of January 1st, 2014, relating to when you repair, improve an item. Let's say you rebuild an engine of a business truck. Historically, when you put a certain amount of money that would be considered somewhat significant, you had to look at useful life to figure out whether this repair was just a repair or did it extend its useful life. And that's all by the wayside now. Now you have to look at different criteria, and it basically gets down to you have to look at the definition of, was it a betterment, was it an adaptation, was it an improvement? And surprisingly, when you look at how this works, sometimes in the past when you looked at an item and thought it would be significant, you may find out under the new regulations it's deductible. And vice versa, where it used to be deductible, you may find out that it has to be capitalized and depreciated over its useful life. Then there's some safe harbor rules that businesses can employ. There's a $2,500 per invoice safe harbor rule for a company that doesn't issue financial statements, and it's $5,000 for a company that does issue financial statements. So you can spend $5,000 for an improvement, let's say, and still not have to capitalize that. So there are a lot of rules and a lot of notices and revenue rulings that have been issued. So if you're in the business, even if you have a rental property, it doesn't have to be a big business. It could be a rental property. It could be any type of business asset, equipment. If you're putting improvements into it and you're not sure, you need to go back to what's called the repair regs to make sure that you've done the appropriate elections, these safe harbor elections, or whether you have to change your accounting method by filing Form 2553. So if you're in that category, you have any type of equipment, you need to make sure that you check that out.
All right. Well, this has been an excellent show. And next week, our special guest is going to be John McAdams of Pioneer Business Ventures. Be sure to stay tuned. And as always, your money matters.